Hi, I'm Tom.
And I'm Brian.
And we are the Dividend Dudes. We are continuing a series of investment strategies talking about what's happening with individual stocks that you're looking at picking them out. Last video we covered the quick and the current ratio. This video we'd like to cover earnings per share and some of the nuances that go along with that. During the last video, we covered a bunch of individual stocks that we had owned, or at least that we were looking at, and a couple of them that were on the list, very ironically, during this video, changed those ratios quite a bit. So in addition to talking about earnings per share, we're going to talk about some of the pitfalls that happen when you're looking at these numbers and how executives can cook the books. So in particular, one of the companies that we looked at was Lumen Technologies. It had a quick and current ratio of like 0.58. So as far as that went, it didn't look real good.
Right.
I mean, it looked like, holy crap, they're not doing so well. Well, when you dug a little bit deeper, you saw that, well, they had a huge dividend. I mean, they couldn't afford it. And a dividend check is basically considered a liability for a company. So when they figured that out, they cut their dividend, and then all of a sudden, the current and quick ratios went from 0.58 to 1.4 each, which was one of the best of the companies in that list. That happened within a few weeks.
That's pretty incredible increase.
Right. So, how do you figure that out when the company goes and they make those numbers look really good? Is it still a good company to buy? Earnings per share has some of the same pitfalls because they are calculated if a company pays a dividend based on that. So as far as Lumen Technologies goes, with the stock that we had purchased, their quick and current ratios look good. They did pretty good that way now. However, if you look at their earnings per share, you look at their cash flow, you look at their balance statement, they're still not looking like they're doing that well financially. So then how do you really know if these two ratios that we talked about in the last video are actually good things to use? Well, they are. They're important to know how to look at those ratios and what they do, but they're not the only thing that you need to look at when you buy a stock. So with regard to that, this is why we want to talk about earnings per share. So earnings per share, if you're looking at a company, is pretty simplistic in its nature. Basically, all you have to do to figure out what that is, if you're looking at a stock symbol or looking at a business entity as a whole, is you got to take their net income. So kind of like if you're working at a job and you got your paycheck, you've got your gross number, and then you've got what's left over after that, and that's always depressing when I look at that number.
And that's pretty easy to find on the balance sheet of a company.
Yep.
If you go to the web, instead of digging in, that's one of the prevalent numbers that you're going to find, and it's easy in big bold letters.
Yeah, there's risks to the net income too, just like with an earnings per share. But basically, it's the net income, and then you're going to divide that by the number of shares. Well, what are really the number of shares? Well, that's the number of people that own the stock. That's how many shares they've issued to people that basically say, hey, I want in. So if they pay a dividend like Lumen Technologies does, or AT&T or DuPont or ConocoPhillips or any one of the other ones that are out there, you have to subtract from their net income the dividend checks and then divide that by the number of shares. So if you have a huge dividend in Lumen Technologies' case, which at that time was well over 10%, and you cut the dividend, you bring it down to, I think it's at 7% now, that earnings per share all of a sudden looks a lot better.
Right, they're not paying out another 7% to your shareholders.
Yep. So earnings per share can be manipulated, and it's a good metric. It's something that you should look at because basically determines, hey, is this company actually making money? If
it's in the name, earnings per share, how much they earn per share.
Right. Yeah. So like if they're making money, that's great. You're gonna have a positive earnings per share number. You're gonna want to look at the industry that it's in, because sometimes like an oil industry will have a different level of earnings per share than a telecom. Technology companies tend to have lower earnings than something that's more service oriented. It really depends on what industry you're looking at. In the case of Lumen, they cut their dividends, so their earnings per share it's still negative. It still doesn't look that good, but I mean, it went way towards the positive by doing that. So a couple of other things that can happen with earnings per share. So if you have the bottom number, the number you're dividing, so if you take earnings per share and you take the net income, you subtract the dividends, and then you take that bottom number, which is going to be the number of shares total, that can affect earnings per share a lot. So if you were to take two companies, they're both worth $10 million roughly, and one of them had 100 shares that was owned, that by different investors, and you had the other one only had 10 shares. Well, obviously the one that only has 10 shares is going to have a really high earnings per share number because there's not that many people that own the stock. So one thing to be aware of is when you're looking at earnings per share, and that's also tied to the PE ratio. We'll cover that in a different segment. But that number can be manipulated by the number of shares that you have. So sometimes companies will issue more stock, and then other times you'll see them buy back stock, which will inflate the earnings per share number because there's less stock that's owned. One really good other company that actually looked pretty good in our last video was Chevron. When you looked at CVX, you saw that their quick and current ratio looked pretty good. Well, if you look at them again today, it still looks okay, but it's less. It looks a little bit worse. Well, why is that? Well, everybody looked at Chevron. They says, hey, this looks like a really a good one to buy. So now all of a sudden they have a lot more shares outstanding. So even though their income hasn't changed that much, when you divide that by the number of shares that are available, that number got bigger. That bottom number got bigger. So then their earnings per share went down.
Right.
So on the flip side, an executive could try to pad their wallet and say, hey, we're going to buy back a bunch of stock shares to make that look better. So there are caveats to it, just like there are with the quick and current ratio, but it's still an important financial metric. At the root of things, it's net income.
See, you would think that a company would want a bunch of people buying their stock so that the stock price goes up and everybody makes more money and the company makes more money.
Yes, and that's actually a really good point, because if everybody buys the stock and the company doesn't know where to invest that money, a good example could be like a $1 billion company versus a $1 trillion company. Well, if you give a $1 billion company $1 trillion, they're not going to know what to do with it.
Right. They're buying yachts.
Yeah, I mean, there's too much money for them to be able to invest wisely. If you give a $1 trillion company $1 trillion, there's a chance that they know where to put those assets and where they that cash flow rather, where to put that and how to invest it. So there's like we talked about where we said size matters in the last video. It still matters. I mean, it still matters to know, hey, if a bunch of people are going to buy this stock, is it too diluted? Like, are there too many people that own this stock to really make it a good value play?
Yeah.
So. That's kind of the point of what earnings per share are. We can actually break that down. We'll pick out a few stocks for everybody to look at, and then also pick out some averages too with those earnings per share so people can kind of see what the normal history of those is. It's really important to note when you're looking at earnings per share, you don't want to necessarily look at the current number. What you'd like to look at is the number that goes back 5 quarters. Now what that is about 18 months roughly. So you got 3 quarters times 5. Hopefully I can do math.
I don't know. Yeah. It's too much.
It's too much.
It's on the spot. There's quarters.
So when you look at the historical earnings per share, that'll give you a really good idea of how much the company is actually growing. So
1.5 years.
About that, yep. So it's historical. So it's kind of like the PE ratio will tell you what the price to earnings is. There's a trailing PE that'll kind of give you what it did over the 12 months. If you're looking at earnings per share, a much more indicative number of what the company's actually doing is if you look at what it was the last 5 quarters. And most SEC regulated businesses will report the last 5 quarters. You can do it annually, but there's a lot that happens to stocks annually. So if you're going to do it annually, that's okay. Just make sure that you understand that works better for very large companies with very established defensive moats and kind of a well-known product name than it does for tiny companies. You can have a tiny company that shows up and does incredible one year and does awful the next year, right, and all your earnings per share calculations don't mean anything.
And that happens a lot in the biological or pharmaceutical companies, where they don't have a large array of products and they're betting on this one product to take off and make them millions.
Yep, and you'll see that, and that's indicative of the earnings per share will actually help temper that a lot, because sometimes it's like, oh, this is the cure for cancer.
Right.
And it might not be. So when they find out it's not, you're going to watch the stock go way up, and then it's going to go way down.
But everybody buys into it because the studies and the research looks promising.
Right.
And so everybody's getting early in to get this thing going until they find out it doesn't work. Then everybody bails and it drops.
Right.
So.
And that's kind of the premise of this first segment is that we wanted to explain what it was, kind of what it did, and there's something else that we want to cover here in the next segment, and that's going to talk a little bit about the product that's being produced. Earnings per share dictates based on what the profit of the company is. The profit comes from either the product or the service that they're producing, and there are things out there that, well, companies that don't pay dividends, or in cryptocurrency's case, that don't really produce much of a product that you can tangibly look at and say, okay, this is the value of that product. So I figure we should talk about that a little bit more, but we can also talk about the like what a negative earnings per share means, other than just, hey, they're not making money.
Right, not doing good.
And then maybe just a little bit more about the products themselves. So all right, so I guess we'll cut it out here because we want to try to keep these videos a little bit shorter than we've had. I tend to hopefully not like to hear myself talk too much.
I think you do. You have a lot of words to use.
I have a lot of words. Hopefully they're meaningful. So, all right, guys, if you like what you're seeing, please like and subscribe to the videos, and we'll come back in the next segment. We're going to talk a little bit more about this, and I think we're going to chase a little bit more about crypto, too, because that's been in the news an awful lot.
Absolutely.
An awful lot. So at least just to understand, what we're looking at, we're going to go back to the fundamental analysis after that, and that's important to know that. But like I said, like and subscribe, and we'll see you in the next video.
As always, happy investing.